So really excited about our guest today, a seasoned investor, CEO, advisor, all around badass when it comes to finding ways to unlock value in businesses, and a good friend, Jon Wiesblatt. Good to see you. How are you, Jon?
Great to see you, Dave. I don't know if I've ever been identified as a badass, but I'll take it.
Yeah,
That's
that's the official when I think of you.
Thank you.
Lots to talk about. Lots to talk about. You're a dynamic guy. You've been around the investment space for a long time.
Yeah.
What's going on in the market today?
Very, very timely that we're having this conversation. So one of the most widely anticipated Fed rate decisions, the Federal Reserve of the United States, they are a little bit late to the game, but decided to cut their benchmark interest rates by 50 basis points. I think that the market was forecasting about 25 basis points. So the 50 came as somewhat of a surprise. We saw a sharp reaction in the equity markets. Lower rates are good for equities. The bond markets, I still think, are digesting 50 basis point cuts. But we also saw commodities start to move higher. The reason you're seeing commodities move higher, and the reason why commodities is important to talk about, is because we're based here in Canada. We are a commodity-driven economy. The TSX and the TSX 60 is very heavily weighted to commodities. And so it is very important for our capital markets, our financial markets, our businesses, our industries, to have a healthy commodity environment. So US dollars should decline with lower rates, commodity prices should rise. And so that's generally the impact we saw from rates. The other thing that's worth really mentioning is that the Fed indicated another 50 basis point cut later this year, and potentially another 50 basis point cut later next year or midway through next year. And the real significance of that, especially like from the way that I interpret that, is the economy is slowing, right? We're seeing declining economic indicators. So job markets, which have been very robust, very healthy, we're starting to see some signs of deterioration at the margin. And so I think the Fed is starting to see some leading indicators, making them a little bit nervous about the economic forecasts, GDP growth going forward, hence getting a little bit more defensive and showing us the first rate cuts since the pandemic.
And inflation being in check would be a huge kind of indicator. Is that why they went deeper on rate cuts? Just because inflation is down to like the target?
Yeah, it's a great question. So as we all know, just based on our own bank accounts and the cost of everyday living for regular people, inflation was running rampant really post pandemic and recovery coming out of pandemic. Food prices, gasoline prices, utilities and energy prices, and other products and services that go into the basket of inflation, where it was up approaching double digits, which is something we haven't really seen in several decades. Hence the reason why we saw the fastest rate of increases for the benchmark interest rate in the last several years. So we've started to see the effects of those interest rates starting to ease inflation, right? So inflation has pulled back. The benchmark in most G7 economic environments is around 2%. So we're starting to see inflation indicators move back to that 2% threshold. Hence the reason why the Fed, the Bank of Canada, and the EU, to a lesser extent, have started to feel more comfortable lowering their benchmark interest rates.
And Jon, how much of what is happening now is already baked in to, from an expectations perspective, like even mortgage rates, like 5-year fixed mortgages? How much of that will actually change, for 25 basis points here and there to come versus how much is baked in?
That's a great question, because as we know, markets are always forecasting what's going to happen at some point in the future. And so when we saw the 50 basis point cut, I think that exceeded expectations. I'm fairly confident that 25 basis points was being priced into markets. So not only just the equity markets, which has really been my area of focus for the last few decades, but also the bond markets. And the bond markets impact the lending rates at the banks, our mortgage rates. So I think that extra 25 basis points over and above the initial 25, combined with the 50 that was signaled by the Fed for later this year, and then combined with the next 50 for the first half of next year, I don't think that that was being expected. And so I still think that you're going to have probably a re-rating of all things that are sensitive to interest rates, including mortgages. So I think that what I really do believe is that mortgage rates are coming off, borrowing rates are coming off, credit markets are going to unfreeze to some degree. And what that really does is that is going to stimulate economic activity in North America. So that's the intention of lower rates. That was another long-winded
No,
way of trying to answer your
this
question.
is great. I mean, I suspect you can go on for a lot longer because there's just so much to this and so many downstream implications. Um, are we going to avert a recession? Have we been in a recession? I know that's a bit,
Yeah,
yeah,
so it's really strange because the normal economic cycles that that I've studied like pretty much since like the beginning of the 1900s, right? You have that expansionary phase, and then you have deterioration, contraction, and recession, recovery. We haven't really gone through a natural progression of the economic cycle as we know it from the textbook. Really, as we've emerged from the pandemic. The pandemic is now almost 5 years behind us, the beginning of it. And so we haven't seen a natural recession. And as you know, the pure definition of recession is 2 consecutive quarters of negative GDP growth. And a lot of the times, the markets have forecasted recession well in advance of that recession. So usually when we're talking about recession, we've already come through it. I do not believe that we have entered recession. To answer one of the questions that you just asked, it is only natural that we will be and should be preparing for economic contraction. Hence, one of the reasons why I believe the Fed lowered interest rates by 50, signaling another 100 basis points at some point in the future. So what you have here is you have an economy that's been in pure expansion for the last, call it 3 to 4 years. We've had limited slowdown. And I think we're starting to see some cracks in the armor, and the growth, is starting to subside a little bit. There's a couple of reasons for that. Number one, I told you about labor markets. Labor markets are starting to show some of their early stages of deterioration. That's a leading indicator. We're seeing other pockets around the world that are very important for economic activity, places like China, that are in fact slowing. Their rate of growth is deteriorating, and that should start to make its way into Western markets. So I do believe that we are now on the other side of the growth curve and we are starting to slow. Do I know when a recession is coming? I don't. But I do think that economic contraction is approaching.
right, right. Okay. So we're like talking macro here. If we kind of distill this down to what this means for the average business out there, and that might be a tough one because all businesses are different. But like, what are you telling business owners now? What should they be thinking about given what we learned?
Let's break that down a little bit and let's start with balance sheets. I know in your business, balance sheets are top priority, and so a lot of companies that are dependent on borrowing as part of their capital structure, so debt markets have been somewhat frozen for the last couple of years as interest rates have been on the rise. Banks have really tightened up their ability to lend to small businesses and small business owners. With rates coming in, with rate
Yeah.
reductions, and we just spent the last 10 minutes talking about those, I believe you're going to get a credit thaw in the market. Banks will become a little bit more open to lending. So that's good for small businesses, right? Access to capital,
Yeah.
The weighting your capital structure appropriately between debt and equity. So I think the debt component is going to be there. The thing that I would be advising businesses today is to be cautious in the amount of borrowing that you undertake on your balance sheet. Watch your leverage ratios, because cash flow, the other side of the equation, if we are entering a period of contraction, cyclically sensitive businesses will see some cash flow deterioration, which doesn't become very supportive for rising debt on a balance sheet. So I would urge business owners, their CFOs, people like
Mhm.
yourself and your audience, to really manage the balance sheet, really pay attention to the amount of leverage that you're taking on, and just watch your debt to equity, debt to capital ratios. That's my biggest advice for business owners as we're emerging through the end of 24, heading into 25.
Impressive, and you've been up to some different things. So give us a bit of a flavor for that.
Yeah, for sure. So I cut my teeth early on in my career as an equity research analyst. So I would find a business in a particular industry because you'd be industry focused and prepare very in-depth research and analysis to present to investors. So people that are, managing mutual funds, alternative strategies, the types of things that moms and pops are purchasing at their local TD or RBC branches. I present that research and give the portfolio managers the opportunity to buy and sell based on that research. So I cut my teeth doing that for a few years. Typically, the evolution of most or many research analysts that are good at their jobs, they eventually morph onto the buy side. So I then went on to work on an alternative asset fund management company and ran a hedge fund for about a decade. The fund had phenomenal returns. It was mostly long short equity, but we did some other alternative strategies, which was really cool. It was a great educational learning experience. After doing that for about a decade, I then went on and ran a very well known Canadian mutual fund here in Toronto, and then some experience following that working inside a very large, well known family office, just helping them steward some of their growth equity capital. And so that was the first half of my career, and now I've embarked upon the second part of my journey, the second half of my career, the back nine, as some people like to call it. I don't want to actually refer to it as that because it's depressing. But I got a little bit tired, felt like I needed to refresh things a little bit, and so moved on to the issuer side and co-founded a couple of companies. I advise and consult to a number of public and private companies, and then more recently, am the CEO. I've been the CEO of two public companies. So it's really a gamut of all things associated with capital markets, and that's really been my journey. I love markets. I've been studying them and investing in them since I was a teenager, and I always tell people that after my wife, my two kids, it's really my greatest passion and my greatest failures and my greatest successes. So that's a bit of a long-winded answer again about what I've been up to.
Yeah, phenomenal. I'm setting you up for long-winded answers here because they're kind of
Yeah.
real open-ended questions. Talk about your entire career to date and what you're up to. But I'll share a little story, which is when we know each other for a long time, but I walked into your office one time. I was CFO in the health technology business, and we were raising money and preparing to go public on the venture exchange. And I'll never forget this. You asked a couple questions about the business, and then you kind of took a pause and you just looked at my CEO and I, and you said, "Why the heck are you guys even going public?"
Yeah.
And I said to myself, "That's a good question." And it was one of those, it's an access to capital. It's a great vehicle to continue to raise capital, but there were a lot of downsides to going public for us. And so, people think about IPO and go public as, pop the champagne cork and celebrate riches. But in the venture space within Canada, many times it's just to continue to live to fight another day and raise capital and what have you. But there are a lot of headaches that come along with that. So talk a bit about the public markets and where you see that line. Who's suitable to go public and who's not. Who are you telling, like you told us, why you're doing this, and who are you encouraging to go public?
Yeah, so it's a very, very good question. And I'm going to go back to that moment in time where we met in my office and I asked you that question because Canadian capital markets are much different than other more mature, larger, more liquid markets such as the United States. So let's look at US markets. Mostly private companies in the United States, they raise capital in typically a seed round. So founders, friends and family, they put some money into a business and they allow the operators to go and start to build that business. After a year or a period of time where there is a demonstrated ability to show some success in that business, that company can go to what we call or refer to as a Series A rounds. And then that's followed on by a Series B, Series C. And really A, B, and C, the linear mode of those capital raises are a direct result of how much success and maturity the business model has gone through, right? And so after you've raised enough capital where you've demonstrated to now new investors, both on debt and equity side of things, that you have a business that is financially stable. It's got a good competitive advantage. It can now thrive in its industry on its own. That's typically when a business is ready to consider an IPO. And so that business will go to an investment bank. They'll hire them, and they'll go through the process of taking a company public to transfer those shareholders or to increase that shareholder base from the private markets to the public markets. And that's typically the normal way that most more mature markets tend to take their businesses from private to public. Canada's a bit different. So the Canadian capital markets are a little bit more amenable to early stage venture capital. So we're almost upside down. So we'll take companies that are public here in Canada that have yet to really, not always, but most of the time, haven't proven that the business model is sustainable, it's durable, it's got a unique competitive advantage, and it's ready to go public. Sometimes the Canadian capital markets will make a bet early on venture. And so here in Canada, what I really look for when I'm advising companies to go public or to do an RTO, which is a reverse takeover, it's common here in the Canadian capital markets, is I like the US model where a business is able to demonstrate that it can generate revenue, it's on the path to EBITDA or cash flow, or can demonstrate that it is generating, and it has some history of its ability to do so. It's got an operating team that's proven with a good track record, a good shareholder base, and that it's a business that is conducive to being public in the confines or constructs of the Canadian markets, because we're a bit unique up here, as I've mentioned. And so that's really what I look for in businesses that are going public. A lot of the times we see business failures that are going public, they crave that access to capital, as you mentioned earlier. But sometimes the access to that capital isn't there just because you become a public entity. You still have to show an investor a return on capital and all of those traditional metrics in order to attract that capital.
And when you say non-conducive, would you say like that's industry driven amongst other factors, business model and what have you? But is industry a big one?
Yeah. So Canada is much different than European markets, U.S. markets in particular. We have very limited depth here. So as I mentioned, a big chunk of our industrial profile in Canada is heavily weighted towards metals and mining, oil and gas, and financials. And so if you're a business in emerging category, let's talk about technology or subsects of technology such as artificial intelligence has been a very popular theme circulating through capital markets. Crypto a few years ago, the cannabis markets. If you're an emerging company like that, it's going to be very difficult to find capital in Canada that is directly specific to your industry, just because of the very limited depth that we have in Canadian markets. If you're a metals and mining company, if you're an oil and gas company, financial services, these are the types of businesses that tend to gravitate towards institutional portfolio managers, institutional capital in Canada. Those are the ones that tend to most of the time succeed in IPOs or listings.
You mentioned RTO. You defined it as reverse takeover and mentioned that many do that here. And I think it's talked about a lot, but I don't think a lot of people really understand the mechanics of an RTO. Can you walk us through
Yeah.
what that looks like?
Yeah, so for a business that desires to go public, sometimes in Canada, they're likely too small to attract the sponsorship from a larger investment bank. So Shopify, for example, when they wanted to go public, they hired, one of the larger Canadian banks or a syndicate of banks, and they walked them through the various steps of going public. They, helped them raise their institutional capital, and it's a very long and a very expensive process to do it that way. If you're a much smaller company with less resources and you still desire or crave to go public, sometimes you can go the path of a reverse takeover. And what that means is you can identify a publicly listed corporation, a shell company with a dormant business. It could be an oil and gas company. It could have been a mining company, which is no longer operating. You can identify that shell, and effectively that shell company that still is a public entity can purchase the shares of your operating business. And it's a faster, it's a cheaper, and often more efficient way for small merchant companies to go public in Canada. And it's become a very common way to access the Canadian public markets.
And there's some other benefits within those shells that come along. Is cash one of them, and sort of board or the people associated with those shells? How does that play in sometimes where there's additional benefits that you can sort of acquire by virtue of those transactions?
Right. So, in few instances, a shell company can come with talent. So it could come with operating expertise or board members that might be helpful for the incoming company,
Yeah.
the incoming asset. That's not always the case, but it can be the case. In some cases, there is cash from the dormant business that remains in the shell that the operating company that is going to vend in its business into that shell can take advantage for working capital or growth. So that can be one of the mechanics that can be very valuable to the company that desires to go public. But oftentimes these shell corporations in Canada are often just structures. They're often just vehicles for these companies that are going to take their businesses public.
Yeah. Yeah. So just staying on the go public topic, given where the market is, like I'm hearing a lot of folks kind of have been waiting. Um, are the floodgates going to open here? Are there a lot of companies like just waiting for the right time for the market and for that to go public?
So it goes back to your comment about access to capital.
Yeah,
So access to capital in larger markets, the US market, for private companies, strong, solid, fundamentally sound businesses, there's been a lot of private equity and private debt available to these businesses. These businesses historically have, when they choose to go public, it's because they expect to get a premium valuation, a better multiple when they go public. However, this has not been the case for many small and mid-sized enterprises over the last, let's say, 12 to 24 months. So the amount of IPOs, traditional IPOs, has been on the decline over that period of time. I would expect that as valuations in large cap, like we all read about Apple and Facebook and Amazon and Nvidia, things like that, that have very, very expensive valuations, as those valuations start to creep down into the mid and small cap space, I think that the access to capital for emerging go public situations is going to expand, and you should start to see a rise in the number of IPOs.
but from an RTO perspective, are there measurements out there like number of shells and in the waiting or dormant companies and the like listings have not been frequent on the venture? Is that something that uh, I guess that's what you're referring to, that you think that could open up significantly? what should people be doing as a result of that? Should businesses be increasingly considering that option now and lining up that option?
So there's a lot of pressure and pain points for small companies to go public. And not every company should make a decision to be a public entity for a number of reasons. Number one, there's a lot of regulatory, things that small businesses have to consider. So you need a very bright and sharp and sophisticated CFO, which can be costly, and for them to help you navigate through that process. So that's number one. The second thing is cost. The cost to be a public company can be somewhat debilitating for a small company that's dependent upon its revenues and its cash flows to, grow the business. So cost is another, and then liquidity, right? Oftentimes, a lot of companies that desire to go public think that on day one they're just going to trade millions and millions of shares. However, that's not often the case. If you're a small, relatively unknown entity and you start to begin trading it in the public markets, especially in a place like Canada, which has lower trading liquidities to begin with, oftentimes your liquidity is somewhat less than you might have expected for. So I advise a lot of companies, their CFOs, their CEOs. I often warn them of these things before making the decisions to go public.
We've got a few exchanges here. TSXV, I think I've mentioned. There's the CSE. Is Neo the other? Uh,
So Neo is now called CBOE
right.
Canada.
Okay.
The CBOE, which is the large exchange from the US, they acquired the
Right.
Neo, which is interesting. The Neo is now CBO Canada, has been building a reputation for being more of an emerging venture-oriented exchange for new technologies, new businesses. So think of things like cryptocurrencies. It's been a little bit more amenable to things like cannabis companies, new technologies, critical metals. So those types of things that are not traditionally the types of businesses you would see trading on the TSX or TSXV, they've kind of moved. So I really do like what the CBOE Canada has been doing. In addition to that, and by the way, I don't have any economic exposure to CBO Canada. I have some experience working with them. They're quite fast. They're quite robust. They're quite efficient for a lot of the constituents that are trading or are soon to be trading on their exchanges.
Okay. And that CSE versus TSXV, what do people need to know?
I think that CSE is even more junior to TSXV. And I think that what people need to really think about when picking an exchange is you want to pick an exchange that's going to be cost friendly. It's going to, you're going to have a solid relationship with the people at the exchange, listing your securities, issuing new securities, just managing your news flow and your regulatory framework with the exchange. That's also important. And then the most important thing about selecting an exchange is access to investors and liquidity, right? You really want to be on the exchange that's going to be most appropriate for your business, and it's going to help to promote your story through the investment community. So trading volumes, liquidity, that's paramount for a decision maker.
All those kind of like market update shows, they ask you for your picks. This is my version. I want to know,
Yeah.
where to make money. Where are you seeing opportunities now in the market? What are things that you're looking at closely? What do you like?
Right. So let's talk about some themes in the market. And then, so we'll start at the
Yeah.
macro and then we'll drill down and then we'll come bottom up.
Awesome.
Right. So we'll start at the top. So you're starting to see, I think, a transition from growth to value. You hear a lot of people saying this. You've heard, if you go back and you look at any of the interviews that I've given or some of the papers that I've written, I've been talking about this for quite a long time. But I am starting to see that transition from growth to value. So you're seeing declining interest rates, which we've already talked about, which is very good for interest rate sensitive stocks. So think about utilities, telcos, midstreams, defensive stocks like grocers. So I like that particular place in the market. Companies that pay high dividend yields, when rates were rising, you had competition for dollars. So money would come out of those equities and they would go into treasuries or T-bills or GICs, which were trading above 5%. So those equities behaved poorly. Now you have the inverse relationship. You have interest rates coming down. So these defensive dividend yielding stocks are starting to become back in favor.
Yeah.
So I've been buying things like BCE here in Canada on the TSX, also trades in the New York. Very defensive stock, strong market share in Canada, a long history of and track record of success. Yesterday, the company just announced that they were selling their minority stake in MLSE, which I believe was something like a 7 to a 9x on that investment, which is phenomenal.
Yeah.
And the dividend yield on BC is somewhere between 8 and 9%. And the stock is trading at its low. So good valuation, excellent yield, good catalyst, like that story. Things like midstreamers and pipelines in the US are all trading at attractive valuations and relative to their 52-week highs and lows. I really like those. You can think of pipeline companies like Enbridge, Enterprise Products in the United States, Williams companies in the US. These are all businesses that have excellent market fundamentals, excellent business operations, and are trading at very, very good valuation. So that's a sector of the market that I like. But there's also a sector that friends and people that I discuss with have heard me talking about for the last 12 months. It's actually an asset category that I've never been a very big investor in, and that's precious metals. Okay, so think of gold and silver. In my portfolios, I've never been a big believer in holding too many precious metals, but now I tend to want to be overweight. And the reason I want to be overweight is a couple of things. Interest rates are on the decline. Again, going back to interest rates. So we see interest rates going lower, which should have a negative impact on the US dollar, and that should have an inverse effect on precious metals. So out of the dollar into other stores of value, such as gold and silver. So I like the setup for gold and silver. In addition to that, now let's drill down to the industry. We talked about the macro. Let's go to the industry. We're starting to see consolidation of big companies. So big companies identifying assets that they want to acquire because valuations are cheap. Consolidation happens usually at 2 points in an economic cycle, either at the top, which is bad consolidation, or at market bottoms, which is good consolidation because it's accretive to shareholders. I believe that we're starting to see that consolidation happening at the bottom of the cycle. So you want to be positioned, if you're an investor, at bottom of the cycle. So for example, in 2022, 2023, we started to see M&A in metals, critical metals. So you saw acquisitions like Rio Tinto buying something called Turquoise Hill, which is a copper deal. In May of 23, you saw BHP, massive company out of Australia. They acquired something called Oz Minerals, $6.5 billion deal. That was copper and nickel. We're starting to see those metals and mining deals transition from critical to precious, which is what I wanted to see. So gold deals are becoming more of the headlines in 23 and now into 24. So Newmont's one of the biggest gold companies in the world. They acquired something called Newcrest. Pan American Silver acquired something called Yamana. Alamos acquired Argonaut in July of 24. And then there's just been a number of other transactions that are happening, which makes me get excited. So I want to own some precious metals and some precious metal equities in my portfolio.
And you would play both sides of like that consolidation, those that could be good targets, those that are the buyers. Like how do you sift through that to identify where you're going to buy?
So consolidation is just affirmation of a trend that I'm seeing. So if the best companies in the world are identifying good value in the market and they're actually pulling out their checkbooks to make acquisitions, it probably signals to us, the investor, that there are other good opportunities as well. So what do I want to buy in terms of precious metal companies? I want to buy businesses that have good assets. So very good grades, like high concentration of their metals that are exposed to precious, so gold and silver. I want to see that. I want to buy companies with excellent operating teams. So management teams are very important in my investment process. And then I also want to own companies that have assets in good operating jurisdictions. So think of Canada, think of Australia, think of the United States. I want to own assets where I'm not worried about politically unsafe jurisdictions.
Yeah.
So those are the types of things that I want to look for when making purchase decisions of precious metal companies. Now, I want to caution your audience that you want to just, these are risky investments, they're equities. These are not utilities, they're not telecommunication companies, like I mentioned with BCE. You have to be very, very careful in your exposure to these types of businesses, these types of stocks.
Right. Yeah, that's a good
Sorry,
call.
now I sound like a portfolio
No,
manager
no,
again.
that's a
And
good call out, which is
yeah.
kind of ties into my next question for you, which really, to the extent you're comfortable being vulnerable enough to share, what's one of the misses? Because this all sounds so logical, and it's like, oh yeah, that all makes
Mhm.
sense. But there have been some misses along the way. Share one of those where you saw something coming, and then just like a complete curveball or black swan
Yeah.
event.
So part of my process historically has been able to identify one of these market trends and then making a bet on a few investments. And typically, I tend to be quite early in my investment thesis. So I can identify a trend, put my bets on the table, and then sometimes you have to wait quite a long time for that trend to make its way down into your investment. So that is an area that I feel I've 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 been not so good at, is timing, and as we know, timing can be everything. And sometimes it's very painful to hold an investment over a period of time when it's in decline. And so it really gut checks you. It makes you think of your investment thesis. Um, so timing is really one of the key elements that has kind of worked against me in the past. In terms of a specific investment that went against me, I have to go back into my memory banks. Just there's not one good one that I could share with you and your audience that I think I could provide any good lessons. So let me think about that, and I'll get back to you next time.
The general nature of where things have gone sideways, I think you've kind of illustrated, so
Hmm.
that's helpful. So as you look to the future and just more around trends, and just getting out of some of the specific environment, the factors kind of stemming from the macro environment, and then where you see opportunity, but more so like trends. You mentioned crypto. Kind of haven't heard as much about crypto now, or
Hmm.
for obvious reasons that kind of took a step back, I think. But whether it's crypto or blockchain or esports, uh, maybe psychedelics, tell me a little bit about where trends are and where you're seeing kind of the puck going.
Yeah, so I'm not quite sure about those emerging industries. So those are very difficult for me, anyways, to identify if that's where, to quote you, where the puck is going. But I mentioned earlier in our discussion that I'm starting to really see the transition from growth to value. So a lot of businesses that are good fundamental businesses that don't have the sex appeal of a crypto company, a cannabis company, an esports company, an emerging sector. I think that those companies are going to start, those value companies are going to start to see some love from the investment community. I think that if you buy them right, if you hold them properly for the duration of of the holding period, I think there's a lot of money to make. So I would urge investors to spend their time looking for not just the next great growth stock, but maybe the next great value stock, which you don't hear many people talking about these days.
That's helpful. Awesome. John, like we've talked a lot about sort of public. I feel like public companies, or markets surrounding public companies. Um, but a lot of companies, as you put it, will never, should never go public. But you love business, like at the core. You know, just talking to a lot of owners of businesses, and you talked about being careful with the balance sheet now, and potentially uh, reconsidering capital structure between debt and equity, given where the markets are, but just like more around business fundamentals, things that have stood true, uh, you know, and stood the test of time and always will. What are some of the things that when you sit down in a boardroom with business owners, you find they don't know, but you impart on them?
So there's a book by Michael Porter that sits on my bedside. It's called Competitive Advantage, and everybody should read that book if you love to study business and you like investing, because at the end of the day, all businesses that are successful, the business is has an ability to demonstrate a sustainable, definable competitive
Yeah.
advantage, whether it's price, whether it's cost, whether it's regulatory, whether it's a technological innovation that's superior to the competitors. If you have a great advantage in your business model, and you've got that moat around the business, then that business, the probability of success will be that much greater. So I really try to identify that in the boardroom with business operators. Not every business can have a great competitive advantage. It's not possible, but you really want to instill that mentality on business owners who are trying to um, build successful businesses. Just focus on your product or your service and make sure that you can promote a competitive advantage within those things. So that for me is really the core fundamental thing that's going to make a company successful.
So John, you're like passionate about this stuff. I mean, everyone could see it that talks to you. You're super knowledgeable. You spend a lot of your time. You've got Michael Porter books on your nightstand. Um, Let me kind of change the topic a little bit here and talk about what else is in your world. What else kind of interests you? What else do you spend your time on? Or is this it? Of course, family. You got a beautiful family.
Yeah,
I know you like to
thank you.
golf. Talk a bit about John and other things you like to do.
Yeah. So, like golfing with my friends, like you, Dave, are things that I love to do. I'm not good at it because I have never been able to devote enough time, or maybe I'm just not all that skilled at it. But I like being outdoors. I like being active. I like spending time with my friends. Um, I can never stop being focused on markets. I could be on another part of the world, and I have to just be on top of what's going on. It's a passion for me. I've got two boys who they've occupied a lot of my time. We spend a lot of time together, so family is very important. So family, being active, spending time with friends. That's really what I love to do. I have a very large family, so my wife and I have many siblings who now are married and have families of their own.
Right.
So we spend a lot of free time with our family.
Love it, love it. And so
Yeah.
if your golf game you said is not very good, then I don't know what that says about me. So for the record, you're pretty good in my eyes. But as I told you when we first got on here, I'm catching up, and I'm planning to catch up. So next season, look out.
I look forward to. Listen, as long as you get me outside and the sun is shining and we get to hang out together, and
Exactly.
I
Exactly.
don't care.
Exactly. John, you mentioned the back nine and on that golf track. And so, there's been a shift in how you've spent your time and where you're looking to spend your time. Like just looking back and reflecting, it sounds like it was a natural evolution from equity, research uh, to give you the foundation for a lot of the things you've done along the way. But if you go back and kind of tell yourself starting out and talk to yourself, what advice would you give yourself starting out? What would you have done differently?
Yeah, I think about that a lot, David. And the one thing that the older version of me would say to the younger version of me is be patient. When you're young and you're full of energy and you want everything now, it's just be patient and put your head down and work hard, learn as much as you can, surround yourself around people that you trust, that are smarter than you. Always surround yourself around people that you can learn from, and be patient and let your career naturally evolve. Don't try to push it.
Yeah.
I find that the younger version of myself was sometimes a little bit too worried about achieving success now and not thinking about how to position yourself for success in the future.
Yeah.
And so I think as a young person, I think you need to think a little bit further out and just have a slower track of getting there. And then the other thing that I would like to tell myself is, don't pay attention to the noise. There's a lot of noise in this world, right? And just focus on yourself and your family and your own career path, and everything tends to work out.
It's great advice. to your younger self and to anybody today that's paying attention. John, what else do you want to leave with our audience that maybe we didn't cover? Because there's just a ton of things. I think we got to have you on again because any one of these topics we can go many levels deeper. But anything else you
Yeah.
want to share with the audience?
Well, I want to plug you and your business, and because we've spent a lot of time talking about CFO Hive and your venture and the business that you're building, and I think I want to share some of the experiences that I've had with the fractional CFO model, and it relates to a lot of the things that we discussed in this conversation, and so namely if you're a young emerging business that is focused on, managing your costs, growing your revenues, building your presence in your market or your industry, you really might not be ready for that full-time, sophisticated, very strategic CFO when that's more appropriate for a more mature business, for a business that's been around for a long period of time. So the fractional CFO business model provides businesses, including businesses that I've co-founded, the opportunity to get exposure to a great CFO, a very knowledgeable CFO, but you don't have to endure the full suite of services and costs associated with that CFO at an early stage of your business evolution. And so the fractional CFO model, it provides a great deal of flexibility for young and emerging businesses. And I think that your model of walking emerging companies to that more mature phase, it allows the company to start with a CFO who can take them through the early stages, and then businesses like CFO Hive can help that company to either continue on with the existing CFO or to provide a different CFO that might be more appropriate as the business matures and evolves. I've used fractional CFOs before, and some still remain in our companies, and others do not. But it's a really really interesting and efficient way for companies to employ a very valuable part of the business. So that's it. That's I wanted to mention that as
I'm
well.
glad I asked for any other thoughts. So thanks for sharing. Obviously, um, I agree, and but really helpful to hear from the perspective of somebody that's used them and had value and identified value. Uh, bringing on fractional CFOs for your venture. So really helpful to hear that perspective. And I think there's an opportunity uh, to get more of that word out and to educate, more businesses and owners of that opportunity in the right time. Um, and I think there's almost untapped opportunity for companies at various stages that, are on that cusp. So it's great that you've been doing it, and hopefully we can continue to get the word out for others. John, amazing. Really appreciate having you here and hope you'll do it again soon.
I'd love to. Thanks. This is a lot of fun.
Awesome.